Yeah, keep them both.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's Tuesday. John Penn joining me this morning. We're going to be talking about a lot of things, like, for instance, should you worry about turnover in portfolios when you're managing money in markets, right? So we're going to get into some of those things this morning. Also talk a little bit about mega caps this morning. Are mega caps due for a comeback? So we'll kind of get into the data behind that as well. So again, got a few things going on this morning. Of course, last night the big news was that President Trump was on X with Elon Musk, crashed the internet temporarily, but finally got it up and running about an hour late, and but had about 1.3 million people listening to his X space last night. So I'm still not used to calling it X, right? It's still Twitter. It's still Twitter Spaces to me. So
it's the Twitter.
It's the Twitter. That is correct. And you know, hey, look, I still have a MySpace page. So there you go. Anyway, people are like, MySpace. Never heard of that before. That was the original, way back when. And my wife and I have been, you know, there's not been a lot of good movies on television as of late, right? New stuff coming out. So my wife and I have been going back and watching some older movies.
Yeah.
You know, some, you know, kind of back from the, you know, last century, like 1999.
In the 1900s.
Yeah, exactly, back in the 1900s. But it's interesting because you see them get on the computer and they're like logging in, it's dial-up, going into AOL. Exactly. It's like, you've got mail. And you know, it's like the net with Sandra Bullock, you know, back in the late 90s. But yeah, it's quite humorous now. Technology's come so far. All right, a couple of things today important. PPI this morning, the producer price index is coming out, and of course all eyes are on that, as well as CPI tomorrow. Don't be surprised. You know, there's a couple of things that are going on that could certainly suppress the rate of inflation in this latest reporting period. But we've had a couple of soft prints in a row, so I wouldn't be surprised if there'll be a hotter print. Again, remember, this is year-over-year comparison. So we could see, you know, a little bit higher than expected print in inflation tomorrow. That would certainly impact bond yields. Importantly, could see a tick up in bond yields if inflation does come in higher. On kind of a short-term fear, maybe the Fed won't cut rates in September. Now, again, and I have no idea what inflation will be tomorrow. Could be weaker, could be higher. There's a lot of mathematical jiggering that goes on in the data, so it's hard to give you a precise, say, oh yeah, I think it'll be 0.3 tomorrow or 0.2. But I'm just saying, just don't be surprised if inflation is a little bit higher. It doesn't really mean much of anything. It's just that we've had a couple of soft prints already, and just the way data works, you're going to potentially get a little bit hotter print tomorrow. We'll see what happens, but PPI today, CPI tomorrow, of course, that's the big one. Then we get retail sales on Thursday. It was interesting. Home Depot reported their earnings this morning, and we've seen a lot of companies now talking about weaker consumer demand, that consumers are really starting to slow down here. So that may well show up in the retail sales report on Thursday. And again, that's 40% of PCE, which is 70% of GDP. So it is not, retail sales are not insignificant into looking at the market and where we're kind of headed from here in terms of economic growth, because economic growth is where earnings come from. So watching retail sales will be very important, but that's also disinflationary. So if we are indeed seeing the retail consumer slow down, that is disinflationary. Not great for the upcoming election for the incumbent, because again, the economy is really, people vote their pocketbooks, right? So if people are looking for a change, much weaker economic growth between now and November is certainly not good for the Biden-Harris campaign. So we'll see what happens as we get there. But again, just something to kind of pay attention to over the next couple of days. This is a very important economic week. And then once we get into next week, we're finishing up earnings for the most part this week. But that also means that buybacks have now started. And interestingly enough, we talked about buybacks coming back into the market. And really, we saw that starting right after Monday. We've seen a lot of windows open back up. We've had $15.1 billion worth of new announcements, new buyback announcements just this week already. So again, a lot of companies coming in, starting to buy back their own shares. Of course, those will exceed more than $1 trillion. Well, they'll be right at $1 trillion of buybacks this year and exceed $1 trillion next year. So that's going to be a big driver for a lot of these companies. But let's talk a little bit about what you need before I'll spit that out. Here's what you need to know before the bell this morning. There we go. See, I'll get it out. So yesterday we broke above, Monday, yesterday, we broke above, I'm sorry, forget what day of the week this is already. We broke above the 100-day moving average and retested it intraday yesterday. So yesterday we were above the 100-day, came down, touched it, and then rebounded off of it right at the close. So that's a very weak test of the 100-day moving average right now, but it is positive, right? So the markets did hold that break above the 100-day moving average that we did see on Friday. So we have now completely closed that sell-off that we saw on Monday. So that whole gap down, that 3% gap down has now been completely reversed over the last couple of days. This sets the market up now for that move up to the 20-day moving average, which has now crossed below the 50. And as we talked a little bit about yesterday, this is going to be kind of key resistance here, at least for the first attempt. So as the market tries to get there, that's where likely we're going to see stocks kind of struggle here just a bit. And again, kind of see a bit of a retest. Now, the question will be, do we retest the 100-day on a pullback and hold that and bounce off that level, or do we come down and retest this recent low before we bounce again and complete this correction process? Don't know how that's going to work out just yet. A lot of that will depend on the data for the next couple of days. So again, if we get much weaker than expected data, some concerns about a pickup in recessionary pressures, etc., that could certainly lead to this kind of a pullback and a retest of support wherever that's going to be ultimately. But again, right now there's a bit of positive sentiment here that markets are recovering. People are starting to feel a little bit better about the markets overall. So again, kind of watch that carefully today. The other side of this, of course, is the interest rates. And again, we had talked about last week that interest rates had moved too far too fast and you couldn't buy bonds at that point. We needed to see those rates retrace a bit. We have seen a bit of that retracement. I think there's still a little bit more to go up to the upside here. Again, I think a little bit hotter than expected PPI or CPI could go ahead and push rates up here towards 4 or 4.1%. Catch the bottom of this falling moving average now, and that's going to provide the new support. But again, not overbought yet, not oversold enough yet on this to determine kind of where we go. But I do kind of expect interest rates to move up here a little bit, bond prices to move down a little bit, potentially over the next couple of days as we go through these inflation reports, if those are hotter than expected. So just be a little bit cautious right now with the markets overall. Again, continue to manage your risk, as we talked a little bit about yesterday. Raise some cash, rebalance your portfolio, look at your losers and laggards. If they aren't working for whatever reason, time to let those go. And then, of course, just pay attention to the overall portfolio balance. Are you heavily weighted in one sector or the other? That's the one thing to kind of really keep a watch on. And remember that whole IWM Russell trade everybody was chasing? We warned you, said be careful, the fundamentals don't support that. That's completely gone. So again, this is why you don't take big risk bets in your portfolio, because these things typically, these narratives typically don't work out. All right, quick break. We'll come back. That's what you need to know before the bell this morning. And we'll pick up with John Penn, talk a little bit about markets and mega caps right after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So let me apologize this morning. I am struggling with my allergies for some reason this morning. My nose has been itching ever since I got in the truck this morning driving into work. I was sneezing all the way to work. So
I had it bad yesterday too.
yeah, and I was fine this morning. I woke up this morning, everything's great. I got in the truck, started a sneezing fit, and my nose has been itching ever since. So I apologize. And I'm stumbling over my words this morning because my brain's trying to stop this tickle. So it'll be fine. So a couple of things to get into this morning. I want to talk a little bit about our article that's on our website out this morning. So we just published a new article this morning. Are mega caps are ready to make a comeback? Been a lot of debate over the mega caps, and of course, they finally had a correction. Of course, those were the leaders for the markets for the last, kind of run ever since the October lows of last year. And of course, we had the whole AI chase, the AI bubble. Everybody wants to call everything a bubble when things are going up. It's either a melt up or it's a bubble, right? And just things can't go up. We just can't have things going up. They have to be a bubble or a melt up. So just be careful of narratives. But it wasn't surprising that we were eventually going to get a pullback in the markets. In fact, we'd kind of written back in June, July. We said, hey, we're going to get a 5 to 10% correction. It's going to happen. One of the charts that we posted was at that time was the 37-week rate of change. And whenever markets have had 37 weeks in a row of just steady gains where they're just kind of rising steadily, that typically tends to mark a short-term peak in the market. So the correction wasn't surprising. So this was published back out in about mid-July. So right after we published this, that was the peak of the market. and then the market pulled back. So again, the correction wasn't surprising, and given that the leaders that were leading were the ones that were driving the boat, so to speak, not surprising that they were all grossly overbought, that those were going to be the ones that corrected. And of course, as soon as NVIDIA and Microsoft and Google went through a bit of a pullback from extremely overbought conditions, AI's dead, the bubble's over, mega caps are done, etc. And so we saw in that process, of course, a lot of degrossing in those areas. And then, of course, the yen carry trade blow up, Friday and Monday. That led to further degrossing of those positions. So hedge funds were selling those positions on a very rapid basis to delever their portfolios. Now, of course, this is like, see, the AI chase is dead, the AI bubble's over, and all, my premise is that it may be just a bit early to be saying that. And again, because we'll go through 4 reasons here why likely the mega cap trade is not over yet. And I'm not saying that it won't ever be over, but there's just kind of 4 big reasons why those stocks will continue to absorb inflows, at least for now. One of those is liquidity. And as we talked about this previously, I think maybe even touched on it yesterday, but these companies like Apple, Google, NVIDIA, they are highly liquid. And so if I'm a hedge fund manager or a mutual fund manager, whatever it is, and I've got to move billions of dollars of capital at one time, these stocks are easy in, right? They have earnings growth, they have fundamentals, and they're highly liquid. I can go buy $1 billion worth of Apple today and not even move the stock price, right? Because it trades so heavily and there's so many shares out there. I can't do that with small and mid-cap companies. So from just a flow standpoint of liquidity, right, these stocks provide a safe haven for Wall Street to hide money in as markets are rising. Second thing, of course, is just the whole passive indexing effect that has become a phenomenon really since 2008, more so than anything else, because we just had an explosion of ETFs post 2008. If there's we have every, we used to have back in 1998, 1999. I remember when I first started doing radio with Brent, there was a guy on in the afternoons at 4:00 and on the drive time home, and I won't mention any names, but Brent will know exactly who I'm talking about here in a second. He'd be eating a sandwich, right? While he's doing radio, he's eating a sandwich, talking about the markets, and he was always bashing. This is like 2000, right? He's always bashing, if you have a financial advisor and he's buying stocks, he's ripping you off. You should just buy ETFs. Well, there was only 3 ETFs at the time. There was the NASDAQ, the triple Qs, the spiders for S&P 500, and the diamonds for the Dow, right? So it was DIA, SPY, triple Q. That was it. That was all the ETFs there were for the most part. And then, of course, after 2008, now we have ETFs for everything. We have ETFs that have one stock in them. I don't know why you just don't buy the stock, right? But you have single stock ETFs that are levered 2 for 1, single stock ETFs that are levered 3 for 1. So we have all these, anything that you can take, you can throw it into an ETF and somebody will probably buy it. So this has led to this explosion of ETFs. And so as you can see in this chart, the global assets under management and fund count of ETFs has just exploded. Really since 2008. And so, but here's the thing about ETFs. Every time I launch an ETF, I've got 2 challenges as an ETF provider. So let's say John and I are going to go launch an ETF. Well, we've got to build an ETF that is going to provide performance for the markets, because if our ETF sucks, nobody's going to put money in it. I mean, what's the first thing you do when you look at an ETF? What's the performance been, right? How is it, what's it cost and what's the performance been? That's it. That's the whole research process for people buying ETFs. And so it's not surprising that you take a look at ETFs, there's like 450 ETFs that all own Apple, right? Because every time that I'm going to launch an ETF, if it's it's a large cap growth ETF, it's a mega cap growth ETF, it's an S&P index ETF, it's just some actively managed ETF, whatever, it's going to own Apple. It's going to own Microsoft. It's going to own Google. And so if you take a look at the breakdown of the S&P 500, as an example, 37% of the S&P 500 is made up of 10 stocks, right? Apple, Microsoft, Google, blah, blah, blah.
So if I build an ETF that's going to track the index, which I've got to do, I've got to at least own those 10 stocks. Well, the problem is that those stocks and all those ETFs, every time you buy that ETF, 37 cents of every dollar goes into those 10 stocks, right? So you just have this consistent money flow coming in from passive indexing of these ETFs, and everything else that goes on in the ETF market is going into those stocks. It's just a function of flows. So thirdly, earnings. If I'm an asset manager, earnings drive the markets. Markets go up if earnings are rising. That's it. So it's no big secret to this. If earnings are rising, asset prices are going to go up because investors will pay more for earnings as they go forward. Well, the only companies that are generating earnings out of the entire market are large cap stocks. The vast majority of those earnings are being driven by those top 10 companies. So again, as you can see here in this chart, if you take a look at large cap expectations, the earnings growth is in large cap, not in small and mid cap. And so this is one of the problems with the small and mid cap trade that we talked about previously as well. There's just no earnings growth for those companies, particularly in a slowing economic environment. This is going to be one of the challenges. Then, of course, lastly, as I just talked about at the open, the buyback window is now open for stocks. And going back to 2000, corporations are the sole net buyers for stocks. So if you take a look, going back to 2000, pensions actually sold off stocks. That's not surprising because they have to meet pension payout plans. Mutual funds have been a negative purchaser because they're going away in favor of ETFs. Households have been a positive purchaser of 0.6, and foreign investors have been a positive purchaser of about 1 billion. So take those first four, net those out, it's about zero. So 5.5 billion, all net purchases coming from companies. So the entire market drive has come from corporate share buybacks in the marketplace. And again, if you take a look at the annual change in share buybacks versus the annual change in the markets, guess what? It's no surprise. There's a very high correlation. So buybacks, which are predominantly done by these mega cap stocks, drive the market. So those are the four reasons why that mega caps are not dead yet. Now, does that mean they're not going to struggle here near term? Sure, because we're still going through a correction process. And that correction process could last here for another month or 2 or 3. We'll see what happens. But as we start to look at this, and again, this is what we keep talking about, just, and we were kind of touched on a bit yesterday in particular, we're starting to get to the point where we're reversing a lot of that overly bullish sentiment. If you take we run a net bullish sentiment chart, for every week. And if you take a look at the Z-score of that chart, it's come down a lot. So this is professional and retail investors combined. So there's been a big reversal in that overly bullish sentiment we saw that's working through the process of this correction. We're not to a point yet that would suggest that we're at a bottom. But I would suggest that as we continue this correction process, again, right now everybody's kind of feeling better about this recovery rally from Monday's sell-off. We're not done. We're likely to have another downturn that will ultimately kind of weigh on that investor sentiment. It's like, oh my gosh, the correction's still going. Yeah, there's probably another leg of this to go before we're done. And then we'll probably ultimately set a bottom. But when we ever get to the bottom of this correction process, wherever it is, I would suspect that mega cap stocks will be a leadership group coming out of that downturn, wherever it comes. So again, just in the bottom of this article, we've got some rules and strategies about navigating this correction process over the course of the next month or two as we head into the election. So that's all on the website now, realinvestmentadvice.com. When we come back, we're going to talk a little bit about a couple things. One is about buying dividend stocks. It's a fascinating question. Also want to talk about worrying about turnover in portfolios. So we'll get to those coming up right after the break with John Penn.
Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Food in total is now making up 30% of the average discretionary income.
I believe it. I mean, that is our largest expense is food.
Yeah.
And we rarely eat out.
The Real Investment Show podcast.
Our biggest frustration at home is how do we do this cheaper?
Yeah. No, I agree. We're running Hunger Games at our house.
At realinvestmentadvice.com.
So, if you can make it to the table without getting killed, you get to eat.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So I want to touch on a couple of topics, of course, and John Penn always kind of brings in topics from clients and prospects that may be of interest to you, things you've thought about or whatever. So it's always kind of good to go over these. But one of them was kind of interesting because, John, I'll let you kind of talk a little bit about turnover.
Yeah. So I had a question come in just regarding, how. Should portfolio turnover be something that one thinks about when managing a portfolio from an active management standpoint?
Right.
And turnover is, how often are trades being made, a buy and a sell, and, what sort of tax implications could arise from that, especially if you have an actively managed portfolio, let's say that's outside of an IRA or Roth IRA. So we're talking about a taxable environment here. So I mean, we are active managers, right? So what are some thoughts there around, portfolio turnover? Because in a way, are we kind of possibly letting the tax tail wag the dog here a little bit?
Yeah, no, absolutely. Right? Out of all the things that, I look at when managing a portfolio, as an example, risk, overall risk, allocation, portfolio return, all those type of things. Taxation is not even on the top 10. because you can't let taxes drive your investment. Now, look, if you're just trying to track an index, then don't worry about it. Just buy an S&P index fund, write it up and down. You have to worry about taxes, right? I mean, it's super easy. ETFs are super tax efficient. But if you're trying to generate returns and reduce risk and create income, then you want an equity-based portfolio that can do that for you. But you can't let the taxation, as you said, the taxation dog kind of wag the portfolio, because it's where I see investors go wrong all the time is they have a stock, they've got a big gain in it, and they don't want to sell it for whatever. It's like, I don't want to sell it because I have to pay capital gains tax. Okay, first of all, capital gains is 20% versus your income tax at 35 or 34 or 33, wherever you're at, right? So it's a 20% tax to sell that at a gain and realize, which you don't make any money in investing until you sell something. It's all phantom money until you sell something. I cannot tell you in the last 40 years of managing money for other people in various forms that how many times I've seen people take a lot of wealth and turn it into nothing by trying to avoid paying 20% in taxes.
Yeah.
So now turnover is important, right? And so and again, like John said, turnover is, how often somebody's buying or selling something. Turnover technically refers to how often is the portfolio turnover entirely. So in other words, if I have a portfolio of 10 stocks, how long does it take before that portfolio turns over entirely? Is that less than a year? Is it 2 years? Whatever it is. But that's turnover. But how often am I trading? And, this is, people worry about it. It's like, oh my gosh, I don't want to pay taxes on this turnover. So yeah, if you're investing in a day trading fund, you're going to have a lot of turnover. Some years, but as an active portfolio manager, I'll tell you, some years we have very low turnover because the markets are just grinding up. And 2021 is a good example. We hardly sold anything in 2021 because markets were just kind of grinding higher. This year is a good example. We've had more turnover, but we haven't had turnover in terms of selling entire positions, but we're taking gains. So back in January, February, March, we were taking gains in stocks, particularly some of the mega caps, before that correction, because we didn't want to suffer that correctional downturn in April. Same thing in June and July, we were selling position, taking gains, because we didn't want to suffer the current correction that we're in, right? So yeah, you're going to pay tax on those gains. Now, we also have some losses. One thing that we try to do, we don't buy, I've been doing this for 40 years. I haven't quite figured out how to buy only stocks that go up. Right?
I'm still working on that?
I'm still working on
okay.
that trick. But when we have losers, we take those. CVS was a good example, right? We bought CVS, it didn't work, we sold it. So we have a loss in the books for this year that will offset against those gains that we took. So we will do tax efficiency. And see, that's the real question that this particular client should ask, is not worrying about turnover, because the whole reason you're here is that you want that risk management in the portfolio. You don't come to us if you want to buy and hold portfolio, because that's not what we do. If you want a risk managed portfolio, that's what we do. So the question is not what is the turnover, what's the tax efficiency of the portfolio, which is a much more important question in his position.
No, I think so too. And, typically, and what I've seen in my experience too, are folks, investors that take profits along the way, raise a little cash into strength, and use opportunities to have a tax efficient investment strategy. It's not just about portfolio turnover, but you're managing your gains along the way versus waiting, I don't want to sell, I don't want to sell, I don't want to sell. And all of a sudden now you've got this really large concentrated position in your portfolio. And to Lance's point, it's like, well, wait a minute, John. Well, I can't sell this now, because if I do, even if my long-term capital gains are 15%, usually like Lance said, they're 20%. Well, I don't want to sell this. I don't want to pay the tax. I don't want to pay the tax. You would have been better off taking profits and taking gains and managing that position along the way, because all of a sudden now you've got this big, large position in your portfolio. And if you're afraid to take those taxes, you are one earnings report away of that being a potential. I mean, the market could take it away from you like that, right? So you really want to manage the risk around these things along the way. So to your point, it's not so much around the turnover and how many trades are made, because It's going to vary depending upon the market environment that we're in. But you want to look at this from a tax efficiency standpoint.
Well,
right?
I've got, and that's a really good point, because I have a investment review with one of our family offices on Wednesday, and one of the tough conversations I've got to have with them on Wednesday is they had positions specifically that they did not want to sell because of the capital gains. Well, unfortunately, 2 of those positions have not done well at all this year. So those 2 positions, which are very large positions in the portfolio because of capital gains tax reasons, have been a real drag on the overall performance of the portfolio this year. So when we go to do the review, it's going to be, hey, look, your portfolio is not tracking, our benchmark. It's not doing well this year, but it's because of these 2 positions that you wouldn't let me sell.
Right.
And they've also had such a big decline is that those capital gains aren't such a big issue anymore.
Yeah.
Right. And so, but this is exactly the point. They allowed these positions to grow to such a large position in the portfolio that it becomes a major impact when those reverse for whatever reason.
Correct. And so if you're having to pay some long-term capital gains tax, at the end of the day, that means you made money, right?
Right.
So, take some profits along the way and make that a little bit more of a manageable position, right? So another great question that I've had too lately is, I think, Lance, folks are looking out there, they're looking ahead and thinking to themselves, hey, there's a better chance that the Fed may start reducing interest rates later this year in September. Possibly. We'll see. So they're starting to think ahead a little bit here about, okay, well, if the Fed starts reducing interest rates, where else can I go, or where else can I start looking for yield?
Right.
So I'm getting a lot more questions around, hey, rather than buying bonds, or is it too late to buy bonds?
Right.
Should I be looking at dividend stocks instead to get yield? Right.
No.
So what are your thoughts there?
Well, the issue is, and while we're talking about this, I'll bring up a chart real quick, because I'm getting a lot of the same questions right now. Because what people do immediately is they start going out and they look for highest dividend yielding stocks, right? And so they start coming across stocks that are, like Philip Morris and Altria and others that pay a high dividend. They're like, oh, I'll just buy that because it's got a 7% yield. Well, a couple of things is that you got to be really careful of that. There's nothing wrong with buying dividend yielding stocks. We run a dividend equity model that has high dividend yielding stocks in it. We're about to sell Philip Morris that's in that portfolio because it's up 27% this year for a stock that has typically not done much of anything and is in a market environment that is going away. People are smoking less, not more. Right? So they've got a real challenge for growth ahead of them, and they do pay a big dividend. But the issue becomes that you've got to be really careful of this because, again, people want to buy these dividend yielding. So I'll just buy it for the dividend. I don't care what happens with the price. Really, can you just bring up the top part of this chart for me, Brent? Let me make that a little bigger for you. That's a little too big. Hold on. Just if you can bring up that little top part right there for me. Just if you can zoom in on the top. There you go. Perfect. So this is a monthly chart for Altria Group going back to 2017. So what people will say is like, well, I just buy it for the dividend. I don't care what the price does. Really? Because you've lost about 50% of the value of your money. And I guarantee you that when that stock was declining, that all of a sudden that yield didn't matter so much because we focus on capital more than anything else. Bonds don't do this. So stocks as a function have no maturity value. Bonds always have a maturity value. So if I can get a 4% yield on a treasury bond or a 7% yield on a stock, I'll take the 4% on the treasury all day long because I know exactly what I will get in the future from that. I don't have to worry about my corpus value, right? The problem with dividend yielding stocks are twofold. One, you can lose big chunks of money in that portfolio. I'm going to show one more chart, Brent. Second thing is that you can have the Intel event. Right? So it's great. This company's paid a dividend forever until now. And you've lost a vast majority of your portfolio. So if you've owned this stock over the last several years, you've lost 50, 60% of your money, and now you get no dividend either. Never, ever, 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 ever buy a stock for a dividend. Because as soon as the economy gets in trouble, as soon as the company gets in trouble, the value falls, you lose half your money. When they lose half their value, they cut their dividend to protect their company. So never buy a stock for the dividend. On a dividend yielding stock, the dividend is gravy. Make sure you buy it for the fundamentals. Come back, we're going to talk about something that's going on in chat right now, which is entirely incorrect, so don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So we'll talk about something that's going on in chat because it's a little bit of a misnomer. In the chat, somebody said that Buffett did a class and asked how many top 20 companies would be around in 20 years. The answer was 0. That's not true. General Electric has been around for 130 years. ExxonMobil's been around since the 1930s. Now, ExxonMobil is not ExxonMobil back then, right? So the statement is not entirely false that whatever company you're looking at today will be around in 20 years. It may be a different company through acquisitions, mergers, whatever it is. And that's a big chunk of companies. If they're in the top companies, right, they get bought, sold, merged, whatever happens. AT&T has been through various forms of mergers and acquisitions, over the course of, used to be Southwestern Bell, now it's AT&T. So, we go through these. So NVIDIA, one of the statements here is that NVIDIA will be gone in 20 years. Probably not. Apple's been around since the late 1980s, right? Still Apple. Microsoft has been around since the late 80s, still Microsoft. A lot of the companies they competed with are no longer around, right? So if it's a fundamentally sound company and they are growing earnings and revenue and have a viable business model, they'll survive more than 20 years. And there's a vast number of companies that have been around, forever. There's companies, though, in areas like we go back to the 70s, Bethlehem Steel is a good example. They're not around anymore. Lucent Technologies, Global Crossing. We talked about these a little bit yesterday, the .com crash. So a lot of those companies that were big at the time aren't around anymore because of mergers, acquisitions. Companies like Yahoo right? One time Yahoo was publicly traded. It's no longer publicly traded, right? It was absorbed. So that happens over time. So yes, some companies that you're investing in today may not be around in 20 years in the same form, right? They may be in a different form through mergers, acquisitions, could be bankruptcy, right? That happens. Companies go bankrupt all the time. Intel has been around for a very long time. They might not be around in the same form at the rate they're going much longer, right? So, but again, doesn't mean that Intel just dries up and turns to dust and goes away. But at some point, maybe they get absorbed by somebody else, another big chip company, Taiwan Semi or whatever buys Intel. Intel's pretty big, so I don't know how that happens. But I'm just saying is that you got to be careful making statements like that because they're not true. You have to go back and look at the statement itself is not incorrect, right? That companies today may not be around in 20 years. That doesn't mean they went bankrupt and you lost all your money. So, you've got to be careful with statements like that because it's a little bit misleading about the way the markets work. And again, this is why at the end of the day, it's fundamentals that matter. Can a company grow earnings? Are they growing revenue? Are they in a space where there is demand for their product, good, or service? Do they have a moat or a barrier of entry to their business? And if you can answer those things positively, you've got a viable investment opportunity. And then, of course, you've got to look at the fundamentals at the end of the day, right?
Yeah, I mean, you were talking a little bit about looking at companies with dividend yield and not letting that be the sole driver, right? Because, I find, too, that a lot of folks say, hey, I just want to buy this company. I'm going to own it for the yield. I'm going to own it for the yield. And all of a sudden, Q1 of 2020 comes around, right?
I'm laughing because Larry says, I tried to slip one thing past Lance and got exploded.
It's all about the love this morning.
Exactly.
Come on.
Larry, we love you, man. It's all good. Just, see, you think I don't read chat, but I do read the chat while you're here. So
he says laughing out loud. That's good.
Yeah.
That's good. You're laughing, Larry.
Yes.
You got to smile sometimes. You got to laugh every once in a while.
Yeah.
It's all good. But no, you're talking about yield, talking about income. So I had a question from a client recently. So here's one. So one of the bonds that we own in our portfolio is a corporate bond.
Yes.
It pays a coupon.
Yes.
Of 1.15%.
Who the hell would buy that?
Exactly.
That's I'll have to talk to Michael. How stupid of Michael to do that.
So the question was, hey, John, I noticed that there's a bond in our portfolio that pays a coupon of 1.15%. Well, they looked at me and they said, well, I'm getting more in this money market that you're using right now than I'm getting more yield out of this money market than I'm getting on this bond right now. I was like, yeah, you're right, but let's take a step back. And let's look at where we bought the bond. What is the cost of the bond? And where will it mature at par, right? So we bought the bond at a discount. So we bought it at a lesser value than par. It's going to mature at par. So between what we bought it for, what we paid for it, and where it matures at, plus you get that cash flow of 1.15%, the total return on the bond or the yield to maturity looks a lot more attractive and is actually pretty equivalent to what that money market's paying,
right?
If not more.
And this is the most important. Look, we don't spend enough time. Nobody spends any time on bonds, right? But this is the most and through your conversation, your explanation right there, you use two different terms that are the most important when they come to bonds, right? So the client calls you up and says, "Why did you buy this 1.15% bond?" That's the coupon,
right?
Coupon is the interest paid on a quarterly, semi-annual, annual basis, right? So if I look at a bond, it says the coupon is 1.15% over the course of 12 months. That coupon will pay, right? The bond will pay 1.15% interest on the face value of that bond of $1,000, right? Bonds are issued out in $1,000 increment. In most cases, some like you get into mortgage bonds, they can be like $100,000. But $1,000 face, I'm going to pay 1.15% on that face. That's the coupon, right? That has nothing to do with the yield. And this is the thing that when you look at bonds, the only thing you look at, disregard the coupon entirely. Because I see this all the time with people buying bonds. Oh, I bought this bond. It has a 7% coupon. Okay, well, what's your yield? 0.5%. They didn't know that, right? They thought they were getting 7% on the bond. Their yield's 0.5%. Yield is the only thing that matters. Michael Leibowitz and I discussed this last week just a little bit during our show on Thursday, is that, there's a couple of different ways to look at it. There's yield to worst and there's yield to maturity. If a bond is callable, in other words, it can be called in by the issuer, redeemed at some point in the future, always look at yield to worst, because that tells you what it'll be if that bond gets called in. And that's the beautiful thing about bonds, that you can't do this with a stock, right? You can't say, well, if I buy ExxonMobil today, in 3 years when I sell it, what will it be worth? You have no idea. With a bond, I know exactly to 1/100th of a penny or of a dollar, what I'm going to get on my money. I can calculate it exactly. So my yield to worst tells me exactly what my yield will be in 3 years when that bond gets called, or 2 years or 5 years, whatever. My yield to maturity is if they don't call it and it goes to maturity, what will my yield be? And as long as those numbers are something you want, buy the bond. Never look at coupon. Coupons are meaningless.
Well, there are times where folks may need to look at the coupon, though, if they really need the cash flow, right? Let's say so there are a couple different ways. Okay, there's a couple different ways I think you can approach looking at bonds. So we can talk a little bit about this. So sometimes folks look at the bond and they go, hey, I really need that coupon. I need that cash flow. So, but to your point, to get that coupon or to get the cash flow that you need, maybe it's 4.25% a year, 4.5% a year, 5% a year, or earlier you said, okay, hey, this bond is paying me 6% a year. Hey, Lance, I need this cash flow. I need this 6% a year. Well, in order to get that coupon, you're going to have to pay a premium for that bond, more than $1,000. Right?
Sure.
So then, because you're paying more for it, remember, you're paying more for the bond, and it's going to mature at $1,000. You're paying a premium for it. It's going to mature at $1,000. So your actual yield to maturity, or the total return on the bond, is a lot less. It might be 0.5%. Right?
Or zero.
Or zero.
Yeah.
But I want the cash flow now. I need it to survive.
Now
right?
that is a true statement.
Yeah.
Right. I won't argue with that. But again, you have to be really careful there, because again, the fallacy that I see from people is that I bought the 6% coupon and they think they're going to get all their money back plus 6%.
That's right. Yeah.
And my point is pay attention to the yield.
Yeah.
The yield is what tells you what your total return on your bond will be, because the one thing that's always fascinated me is people buy a bond and they pay a premium on it and they're getting this yield that they want, and then the bond matures at face value. So I lost money on this bond.
Yeah.
No, you didn't. Look at your yield. That tells you what it's going to be. That includes your yield includes either your capital appreciation or loss of your principal value when you bought that bond.
Yeah, you got to take those cash flows into consideration, right? And there are different types of bonds out there. So let's talk a little bit more about a certain type of treasury bond. There are zero coupon treasury bonds where you buy them, and hence the name zero coupon bond. It doesn't pay you a cash flow. You just buy the bond at a very deep discount. Maybe you buy it at, and who knows, it depends on the maturity of the bond and the length of the time, but who knows, maybe you buy it at, $30 and it's going to mature at $100. There are times where a bond like that, where I know I'm going to buy it at a discount today, and if I hold this bond for 10 or 15 years, I know I'm going to buy it at $30 or $35 or $40 right now. Well, when it matures, as long as I hold on to this bond, when it matures, it's going to mature at 100. I've seen bonds like that used for college planning. When my daughter is going to go to school in 15 years, I'm going to buy the zero now. It's going to mature in 15 years. I know exactly how much I'm going to have when that bond matures.
There you go.
Right?
All right, that wraps up the show for the day. Thanks for hanging out in our chat. We appreciate it. John Penn, thank you so much for swinging by. Be back tomorrow with Danny Ratliff. We'll catch up on PPI this morning. We'll talk about what that looks like tomorrow morning. Of course, tomorrow we have CPI, so we'll kind of get some inflation data to talk about here a bit on the show. So we'll see you back here tomorrow morning. Get by the website, realinvestmentadvice.com. Our mega cap's ready for a comeback. That article out now. And make sure to like and subscribe to the channel. We certainly appreciate you being here, and we'll see you back here tomorrow.